Welcome back to Trade with Conviction, where we cut through the noise and get straight to what's really moving the oil markets. Today, we have June and Neil back with us to talk about the whole barrel and give us a lowdown on the state of the market, with a big focus this week on the crude market, given the recent headlines and beginning to look forward into the new year where Chinese crude import quotas are as normal renewed. So look, let's dive straight into it this week with the latest news and the headlines. Neil, do you want to take us away on this one?
I'll go for it, yeah. So the first topic, I suppose the running topic all the way through is just the state of fear about sanctions. I think that's fair. I think we're past the peak fear. You can see it in some elements of pricing. Brent front spreads are down at least 50 cents versus where we were initially. Mm-hmm. The AG spot market, as we'll go into time and time again today, is looking weaker in terms of their premiums. Maybe not on a Dubai versus Brent type basis, but at least in the premiums, things look weaker. And everybody I speak to tends to have the same message, which is rinse and repeat, circumventions will happen, oil will find a way. And things like the Gunvor purchase of Lukoil assets, that all goes in the same direction. So I think we've hit the peak fear. Do you kind of agree with that, guys? June, Rachel?
Yeah, I think so. I think that's fair. Keen to hear from June, actually, because she's probably been in front of customers kind of this week and a bit more kind of close to the market.
Yeah, I think we are at the peak, and I think we'll talk a bit more what else we saw in the market that points towards that.
Okay. Any other big concerns?
No, I think we can talk about Ukraine. I mean, Ukraine's back in the news. Obviously, they were hitting operations in Tuapse. I never know what it is.
Yeah,
Tuapse. And so I think that's the bigger concern of getting Russian oil to market medium term is still this thing, and we're still in the early phases of this new style of warfare from Ukraine. So I think that should be the main concern about Russian oil flowing. The other thing is just there's a lot of confusion or lots of conflicting headlines around the status of Indian and Chinese buying of Russian crude. So I think that the fair summary is you see lots of headlines from some Indian refiners saying they're going to stop purchases or have already stopped purchases. Others are not doing so. And it's kind of the same situation in China where SOEs are reportedly stepping back from purchases. Some independents are stopping purchases. Others are going full throttle and buying a bunch of ESPO cargoes. So there's actually a mixed bag. And there was some news that came out this morning that Reliance are actually going to resell some spot AG on the market. So that also is quite a confusing picture. Mm-hmm. And my gut feeling is, as we've just said, or our gut feeling, right, June? This is a short-term paying lip service with respect to, okay, we've got to get trade deals over the line. We have to make it look like we're complying, and medium term we'll just be back to normal and Russian crude will be bought by both parties as normal, essentially. Is that fair?
Yeah, if you think about it, it's only 2 weeks or so since the US sanctions was announced, and there was so much heat at that point of time, optics-wise, and all the verbal things that came out. And also, of course, there was a flurry of buying at that point of time. Now we are seeing like the inverse, right? You're actually reselling out the cargoes is just exactly where we expected it to be, which is Russian barrels are likely going to find its way back into India as well somehow.
Yeah.
Okay.
And it's a good lesson. It's a good lesson for us, because when the headlines came out, again, we ourselves, including me, got into a bit of a tiz about it. Oh, what's going to happen? You know, is this finally the big one? And it seems like, as ever, it's a rinse and repeat, and it's just worth remembering the next headline that comes out. Let's look at the fine print before we start writing and discussing. Let's think. We really need something to be vastly different in order for these sanctions to have a big impact.
Okay. All right. Well, I'm sure we're going to pick up on this even more kind of as we work through kind of what this physically means for the crude market in terms of pricing. But look, any other bits of news or data that's come out over the last week, do you think?
Yeah, there's a few things. I'll just fire through it. So I think last week you guys discussed the OPEC meeting. So
we did.
They did in fact raise again for December. That's pretty much as expected. It's another small hike. But then, of course, they said they will pause in Q1. Many journalists writing me this week oh, what does this mean? And I think it's just prudent, right? It's not really a surprise admission that there's a glut because the whole market knows about this glut. So it's more just the prudent move, and I don't think it hasn't really supported prices. It's more like, okay, yeah, we kind of expect them to do this if we're going to be 3 million barrels a day long next year. So my impression is that it's just one of these small boxes ticked. And if the
Yeah.
market is going to refute the glut story, it needs to have 10 of these small boxes ticked, and so it's just one.
Yeah.
And I think that's all we need to say about it. It's just, okay, fine. They're not going to
Yeah.
make this problem any worse.
Yeah, so not a massive game changer, but
Yeah.
slightly a small win for Q1 balances, but many
Yeah.
other things kind of taking effect as well around that.
Yeah.
Okay, anything else that you've got for us?
Let's just quickly run through the US data. So there was the PSM, and pretty much as anticipated, US crude supply remained fairly strong.
Yeah.
Still not in some kind of free fall. So that's not a win for Q1 balance. Things are slowing down on a growth perspective, but you can't call the US supply picture a win for the Q1 balance yet. A couple of things to point out was I thought that the sort of US gas oil demand was suddenly quite weak in August, and it diverged from the weekly data a lot. So weekly data had been undercounting for many, many months, and then
Okay.
it's now been overcounting in August. And that tends to happen. But I'm just noting a few things. So if we look back to the Jody data in Europe, gasoline demand, I think, declined in August in Europe for the first time in a long time,
Yeah.
year on year. And the US also looks kind of weak. So it's just relating back to if what is going to weaken this crack picture, this refining margin picture, medium term. If we make the assumption there's not enough refining capacity, the only thing that can happen is that demand gets
And,
weak enough to start to loosen up this balance. And I'm not saying it's here, but there's some very early signs that maybe it's happening. We just need a bit more time to get ourselves convinced.
okay, one to watch then. Possibly kind of not one for Q1, but that sounds like a latter kind of going into the second half of next year piece that we'll keep an eye on. Anything else before I start to kind of pick your brains on crude?
Yeah, let June largely take over after this. Sorry, it's become a bit of a monologue, but there's lots to talk about. And the last thing is the weekly US data, right? So last night was really bullish. The crude is supposed to build in the US, but it's still quite anemic for the time of year, and total products are drawing really hard. And so I can understand that the prompt is still backward because we've got the
Yeah.
headlines short-term switching of Russian, and the US picture just looks tight. And I don't fully understand it. One thing I can say is that they're exporting a lot of crude, particularly on a net basis versus last year.
Yeah.
And I am still going to make the statement that they are exporting the pressure away for now. And it maybe is also even related to more buying in Asia, but that could be temporary.
Yeah.
I don't know if it's going to last. There's a lot of talk in the market about US oil and water as well being quite high. So let's see if it lasts. But the picture, understandably, tends to support a bit of backwardation at the prompt just now.
Okay, fair enough. We're still in maintenance season as well, so that'll get kind of one back at some point, but that all depends on buying programs going forward. Okay, in that case then, whilst we're still on the topic of crude to a certain extent, why don't we switch from kind of discussing about the US briefly to Dubai, which I'm sure is one of the key indicators of how big an impact the short-term change in Eastern buy-in and Russia's having. We talked about it a little bit earlier, so why don't we start thinking about what this translates to in terms of pricing? Who wants to take this one, June or Neil? Neil?
I'll start just with the very first statement, right? And
Okay.
we already said the spot AG market has started to cool again.
Yeah.
I think one of the reasons that it didn't spike that much or not sustainably was that there is just enough supply around, right? So even with a bit more switching by the Indians, there is just plenty supply. And I think that's one thing I think that is probably a fair statement. And then the question that June and I have been discussing internally is, what's the outlook for the next couple of months? Because we have more supply. What's Chinese buying going to be like? What's the term picture going to be like? What's the SPR picture going to be like? And that's where I will hand off to you, June.
Okay, June, let's continue. And as Neil said, moving forward to next year, you guys have been discussing internally. I've seen all the Slack messages kind of kicking off this week. But what does the market need to consider around spot to buy? Term buying is one topic, as Neil brought up, but so keen to hear your thoughts on this one.
So right now we are in the midst of finalizing term buying contracts for 2026. I used to be part of those discussions when I was back in Bocom Refinery, so it's quite dear to my heart. So I'm trying to put on my hat, right, from a refinery point of view. What would I do? Would I buy more term, or do I, buy more spot and leave it to the markets? So one consideration is the likely oil glut, or at least the talked about oil glut.
Yeah.
There should be plenty of oil to buy in the spot market if I wanted to. But then if I reflect back on 2025, it has been a very turbulent year geopolitically. At the same time, we are seeing fairly robust refining margins. We are seeing more refinery capacity constraints right now. Units shut down. There are some big startups in 2026, but not that much. Additionally, we got, of course, the attacks on refinery infrastructure in Russia. So I think this will actually tilt end users to lock in more term barrels to shield from further volatility. And of course, we have plenty of term crude around from OPEC, particularly Saudi. And I'm now putting on the lens of who's going to buy that term barrels. So China is, if you don't know already, is the largest oil importer of the world and the largest buyer of both Russian and Iranian oil. So if Russian barrels are looking somewhat inaccessible due to the US sanctions, we've got SPR buying to fill 11 SPR sites in 2026. That's a fairly compelling reasons for China to commit to incremental term cargoes.
Yeah.
And yeah, so that's where we feel, term buying will be likely to increase next year. There's plenty of West crude supply growth as well next year. Prices are relatively low, but volatility is high. So I think China will be wanting to shield from this volatility. Medium term wise, Russian purchases should return back to normal. And therefore, the takeaway is there is still a high chance for the current AG spot market to really tank with more term buying and Russia barrels back in the slate.
I think that's a really sensible approach, to be honest, because you lock in your kind of 2026 program to a certain extent on term just to shield that. And you're right, this year has been a little bit choppy, shall we say, and somewhat kind of on the quality of crude that's accessible as well.
But today we also had the OSP release, and it was actually lower than our prediction. So It could be an indication of Saudis giving a bit of sweetener to get you to lock in more term barrels as well.
Okay.
We are there to offer at a discount.
Nice. Okay. So look, another factor to think about here is the SPR build in China, which you talked about. So what do we know so far about this? And what do you think is going to likely happen next year based on everything that you just talked about?
Okay, on paper, we should see SPR build accelerate basis the plans.
Yeah.
We are seeing an estimated 169 million barrels of storage capacities over 11 sites coming online next year. That works up to be 2 weeks of additional days of cover, assuming crude imports are averaging 11 million barrels per day in China. Currently, there is about 36 days of cover within the state-run SPR versus what is likely the target of 90 days of cover. It's 109 days if we include commercial storage together with the state-run SPR versus the likely target of 180 days. So at the very, it's quite it's still a long way to go essentially if you want to really stop build to the target level.
Yeah.
And when we calculate at a very conservative rate of 500 KBD of stop build, it takes actually 3 years to reach the 90 days target. So in other words, the capacity is there for China to take in more crude to build the strategic reserves to buffer for any supply shock. Whether this means, however, that next year's total crude imports will rise or not will still depend on, number one, whether the runs in the state-owned refineries will be there, because we hear like some capacity rationalization happening.
Yeah.
Internal demand might be weaker, and they might be capped by product export quotas as well. And of course, the crude import quotas for the independent refineries. Secondly, flat price. If flat price is low enough, their stock build rate will go up, but the inverse could happen, and we may see China stay back a little bit. And finally, the possible degree to which China needs to suck up the Russian oil in the market.
Okay. June, you were swiftly turning into kind of our SPR expert. I remember being sat with you during APEC when you were trying to figure out kind of what this actually meant back then. So thanks for that. Neil, I think you had a question, actually.
No, I think I just wanted to, I realise now, reading back on our little notes, that we haven't explicitly talked about the crude import quotas yet today, right? So the whole story has been, part of the reason Chinese buying might have been a little weak has been the lack of quotas. And we should explicitly say those get renewed for January arrivals, right?
Yes, indeed.
So that's another reason to expect that Chinese buying can kind of revive a little bit. But on the other hand, we're talking now about, what's the likely percentage of that being spot AG over term crude, over illegitimate sanction crude, over west of Suez crude. All those things seem like the spot AG percentage might actually drop. Is that fair?
Yes, indeed. And the crude import quota for next year, we are thinking is going to increase versus this year, simply from the view of two refinery startups. One is Hubco, which is a joint venture between Aramco, Huajin, and Panjin. That's 300 kbd. And there's another 400 kbd of Yulong second train startup that has not been done yet this year. So that points to a higher crude import quota. Yeah, and then basically January, we might then see the independents who were suppressed from their buying in the last 2 months coming back to buy again for replenishment.
Okay.
And some of it might be Russian HSSR, right? So that's another internal topic of debate with Hua. How much will be HSSR? There might be incentives to buy a bit more than we've seen over the last few months.
If the economics stay firm on that one.
Yeah.
Cool. All right, then. Look, keen to bring this back to closer to the short-term markets, because I think we are talking about kind of at the minute things that will have an impact going into the first half of next year. But what is happening to the rest of the crude picture lately? I think we've been talking about kind of spiking freight as well this week. So who wants to take that on?
I'll take this one. So
Brilliant.
VLCC market has been on fire again. I think the freight market really has been on the uptrend since maybe a month ago, and it just keeps coming back. Right now, we've seen for this rate to the east skyrocketed. That's closed off more the arb to Asia that looked very open initially in late October. Of course, FOB gains helped as well. But from our own signals dashboard, we have this thing called RBI. That's a relative basket index. It's showing TD3C now undervalued by $4.40 per ton. Works out to be about 20 world scale. On the other hand, we have TD22 significantly overvalued by $964 per ton, which is about 2.6 million versus the rate today. So that directionally could make AG crudes landing more expensive versus WTI if the freight component moves to our predictions.
Okay. One to keep an eye out in our crude signals dashboard, but just to be clear, kind of, so that means kind of all the Northwest Europe kind of grades now closed going into Asia for the foreseeable. All right. So we've covered Northwest Europe to a certain extent. What about the OSPs? What's the latest news on them?
So I just mentioned as well, the Saudi OSPs were released today. All the action is all in the Asia side. The ALC OSP dropped by $1.20 versus November. That's quite a hefty discount. And even bigger discount of 140 cents per barrel for Arab medium and Arab heavy. That's reflecting the current weak high sulfur fuel oil cracks. Yeah, for US Gulf Coast, it's down 50 cents across the board for all grades, and unchanged in Northwest Europe and the Med. Yeah, so if we are thinking that this is likely going to steer more people to buy term barrels than the spot market, and therefore the AG spot market should directionally tank.
Okay, I think we've been really, really clear on that point today.
Yeah.
So this all looks kind of trending towards term contracts. VLCC's kind of playing a good game here, keeping kind of arbs shut, and let's see that spot market come off a little bit in the next couple of weeks then in that case. I might actually come back to you right at the end, June, and ask kind of what are the 1-2 things that you're looking looking at going into the next week or so, just to kind of solidify kind of this view even more, I should say. But look, why don't we move into the quick fire round, where we will look kind of at the rest of the oil barrel. We're going to try and keep this one short and sharp and quite snappy. Neil, you've been very quiet today on this podcast, outside of the
No,
monologue, kind of to start with.
well, I had a huge monologue at the start.
Well, you know what? I'm going to put you back on the box, actually. Why don't we kick things off with light distillates and give June a well-earned rest?
Okay, I'll fire through it. I also have a tendency to waffle in the quick fire round, so I'll try not to waffle.
Right.
So light distillates, first is a couple of things we are noting. The first is that the Med naphtha market came off quite strongly. So if you look at things like the Med versus Northwest Europe diff, that's plummeted actually, and part of that is related to a spike in TC6. But the physical picture actually looks a bit weaker, generally speaking, so a lot of the FOB pricing's come off for various specs. I wonder if there's just a bit of a relaxation because it's kind of not so much fear about Russian flow, although the two APSI news could change it a bit. And the thing that's happened is that the unusually open arbs to the east, like the light and OSN arbs, which are not normally open, those have closed off now to the east. And even the Skikta, the sort of classic Skikta arb, is looking a lot weaker. So maybe there's just a bit more flow that needs to escape into Northwest Europe and New York Harbor, actually, which is kind of open.
Okay.
On the gasoline side, the big kind of stories are that Pernis is now returning and Antwerp should be returning soon too.
Yeah.
So what we think is that things like the E10 blender margin in ARA, which has been very open for weeks and weeks and weeks, will now start to ease and return to a kind of normal. Yeah. And it's important to make the distinction between the E10 and the E5. So the E10 would be more the actual physical need to blend real supply, which has been very firm because we have lost so much supply in Europe recently, versus the E5, which is more the paper kind of situation. So that's something to look forward to. That's a kind of weakening factor. But a lot of the ARB picture for ARA actually looks quite supportive just now. So it's a bit of back and forth. And of course, Dangote's off. Probably going to be off in the next few weeks. Blah, blah, blah.
Goodness, that's the first time you've kind of mentioned that during this week's pod. I'm going to see if we can just keep Dangote running weekly until Christmas. So,
let's stop there on Dangote. And the other thing is that the TA ARB has been rallying, actually. So just looking at purely from the stock picture, actually US gasoline stocks looks kind of urgent, like more urgent than the diesel side, particularly last night. And that might be partly driving it. The naphtha ARBs are opening up, or more naphtha ARBs are. The TA ARB is recovering. So yeah, it all just looks a bit tighter in sort of the US gasoline picture. And the refinery supply there in the weekly data looks extremely low. Not always the most trustworthy thing, but it looks very, very low.
Okay, one to watch on that one. It was also good to get Miles's take on the E10, E5, name dropping our co-founder here. It would be wonderful to get him on the pod to talk about gasoline at some point, but let me see if I can work my magic on that one. Okay, so middle distillates, anything interesting going on there?
Always interesting stuff. The one of the main changes is the HOGO. So the HOGO had been rising a fair bit over the last few days. We kind of had set the seed for that a few weeks back because we were just looking at the pad one stock situation and going, hey, that actually looks pretty tight again. So it might be related to that, but it's super volatile, all the components of the ARB just now. So TC14 absolutely plummeted. And so I was going to come on this pod and say, hey, look, the Gulf Coast to Rotterdam MR ARB is super closed, but looking at it this morning, it's now back to open because freight has just collapsed. So it's one to watch. I don't want to give too much of a fundamental view on that yet, but it's looking very volatile.
Okay, all right. Maybe we can get James back and test his bullish theory kind of in distillate next week. Speaking of freight, who wants to take the freight part on? June?
Yep, okay. So talking to Michael on this, the view is that the global DPP is bullish. Almost every geopolitical headline that we are seeing of late leans towards bullish for DPP. And we've heard headlines that 9 more LR2s are dirtying. And historically, when CPP is dirtying, is a top indicator. Yeah. But right now, the top doesn't feel like it yet. we are seeing tight supply across all vessel sizes and regions and supportive geopolitics. And of course, the more oil on water story for longer is bullish freight.
Yeah.
It's not just for sanctioned crude, it's also for the US and the Saudi on water as well.
Okay. All right. It'd be good to get Michael back on as well. I don't think we've spoken to him for a couple of weeks as well. Okay, June, Neil, quick one from the both of you. June, thank you so much for taking us through crude and obviously the freight picture as well. What are the 1-2 things that you're looking at in the next week or so to solidify kind of our view? It was a good deep dive into Asia, to be fair. So
I'm monitoring closely the ICE Melbourne premiums to Dubai. It has been falling. So I think there's still room to drop some more given the situation. And that will be the barometer for general AG spot market view that we have.
okay, cool. We'll keep our ears to the ground as well on whispers of any term contracts being kind of signed up as well in that sense. And Neil, given you took us through kind of the rest of the barrel, what are the 1-2 things that you're interested in the next week or so?
Well, we haven't got too many very good calls on sort of east-west type things just now. I mean, clearly we are looking at Asian diesel as being the next one to kind of weaken after quite a long time of arms pointing east. We've not really discussed that today. I think that the main one I'm thinking about is just the level of cracks. So you have, I'm just looking now again to check, what's the diesel crack doing? It's back to 35 for November. Clearly that's extremely inflated, and it's inflating the margin and our complex margin indicators plus $10 per barrel year on year just now.
Okay.
You have to question whether that's sustainable. I know that sort of the product market's a little bit tight still, but I have to question whether that's sustainable. It's just a question of how much can it fall and when do you buy the dip? I think that's the main story just now.
Okay, fair enough. Let's dwell on that a little bit more kind of over the next week. I'm sure we're going to kind of come up against some new headlines as well, but thank you very much both. So look, that's all from June, Neil and myself. Big thanks for listening. And if you've learned one thing today, it's that markets can't sit still even for 5 minutes. We've covered a fair bit from the fate of Russian oil to more tightness in the product markets. Let's question those refinery margins, that's for sure. So if you agree, disagree, or just have a chart that proves us wrong, send it our way. We really do love a good debate. So catch you next week. Same chaos, new headlines, and always with conviction.